Reading out of the Code of Federal Regulations, the Truth in Lending Act, and I'm in Subpart E and talking about disclosures for reverse mortgages, requirements for reverse mortgages. The definition for purposes of the subpart reverse mortgage transaction means a non-recourse consumer credit obligation in which 1. A mortgage deed of trust or equivalent consensual security interest securing one or more advances is created in the consumer's principal dwelling, and 2. Any principal interest or shared appreciation or equity is due and payable other than in the case of default only after the consumer dies, the dwelling is transferred, or the consumer ceases to occupy the dwelling as a principal dwelling. B, and this is all 1026.33, by the way. B, under 10.2633, requirements for reverse mortgages, explains the content of disclosures required for reverse mortgages, in addition to other disclosures required by this part. In a reverse mortgage transaction, the creditor shall provide the following disclosures in a form substantially similar to the model form found in paragraph D of Appendix K of this part. 1. Notice, a statement that the consumer is not obligated to complete the reverse mortgage transaction merely because the consumer has received the disclosures required by this section or has signed an application for a reverse mortgage loan. 2. Total annual loan cost rates. A good faith projection of the total cost of credit determined in accordance with paragraph C of the section and expressed as a table of total annual loan cost rates using that term in accordance with Appendix K of this part. 3. Under the contents of disclosures is the itemization of pertinent information. An itemization of loan terms changes the age of the youngest borrower and the appraised property value. 4. Explanation of table. An explanation of the table of total annual loan cost rates as provided in the model form found in paragraph D of Appendix K of this part. And C is the projected total cost of credit. This is another letter under the requirements for reverse mortgages. The projected total cost of credit shall reflect the following factors as applicable. That's 1. Cost to the consumer. All costs and charges to the consumer, including the cost of any annuity the consumer purchases as part of the reverse mortgage transaction. 2. Payments to consumer. All advances to and for the benefit of the consumer, including annuity payments that the consumer will receive from an annuity that the consumer purchases as part of the reverse mortgage transaction. 3. Additional creditor compensation. Any shared appreciation or equity in the dwelling that the creditor is entitled by contract to receive. 4. Limitations on consumer liability. Any limitation on the consumer's liability, such as non-recourse limits and equity conservation agreements. 5. Assumed annual appreciation rates. Each of the following assumed annual appreciation rates for the dwelling, which is 0%, 4%, and 8%. An assumed loan period, number 6. All of this contributing to the projected total cost of credit. The assumed loan period, Roman numeral 1, each of the following assumed loan periods as provided in paragraph L of this part, which is A, 2 years, B, the actuarial life expectancy of the consumer to become obligated on the reverse mortgage transaction as of that consumer's most recent birthday. In the case of multiple consumers, the period shall be the actuarial life expectancy of the youngest consumer as of that consumer's most recent birthday. And C, the actuarial life expectancy specified by paragraph C6, Roman numeral 1B of this section multiplied by the factor of 1.4 and rounded to the nearest full year. Roman numeral 2, at the creditor's opinion, option, the actuarial life expectancy specified in paragraph C6, Roman numeral 1B of this section multiplied by a factor of 0.5 and rounded to the nearest full year. 1026.34. Prohibited acts or practices in connection with high-cost mortgages. So I'm going to roll right into another section. A is prohibited acts or practices for high-cost mortgages, and 1 is home improvement contracts. A creditor shall not pay a contractor under a home improvement contract from the proceeds of a high-cost mortgage other than Roman numeral 1 by an instrument payable to the consumer or jointly to the consumer and the contractor, or Roman numeral 2 at the election of the consumer through a third-party escrow agent in accordance with terms established in a written agreement signed by the consumer, the creditor, and the contractor prior to the disbursement. So for home improvement contracts, that consists of the prohibited acts or practices for high-cost mortgage loans. And number 2, notice to assignee under prohibited acts or practices for high-cost mortgages. A creditor may not sell or otherwise assign a high-cost mortgage without furnishing the following statement to the purchaser or assignee. Notice, in parentheses, this is a mortgage subject to special rules under the Federal Truth in Lending Act. Purchasers or assignees of this mortgage could be liable for all claims and defenses with respect to the mortgage that the consumer could assert against the creditor. 3. Refinancings within a 1-year period prohibited under prohibited acts or practices for high-cost mortgages. Within 1 year of having extended a high-cost mortgage, a creditor shall not refinance any high-cost mortgage to the same consumer into another high-cost mortgage unless the refinancing is in the consumer's interest. An assignee holding or servicing a high-cost mortgage shall not, for the remainder of the 1-year period following the date of origination of the credit, refinance any high-cost mortgage to the same consumer into another high-cost mortgage unless the refinancing is in the consumer's interest. A creditor or assignee is prohibited from engaging in acts or practices to evade this provision, including a pattern or practice of arranging for the refinancing of its own loans by affiliated or unaffiliated creditors. Number 4, under prohibited acts or practices for high-cost mortgages, you have the repayment ability for high-cost mortgages. In connection with an open-end high-cost mortgage, a creditor shall not open a plan for a consumer where the credit is or will be extended without regard to the consumer's repayment ability as of account opening, including the consumer's current and reasonably expected income, employment, assets other than collateral, and current obligations, including any mortgage-related obligations that are required by another credit obligation undertaken prior to or at account opening, and are secured by the same dwelling that secures the high-cost mortgage transaction. The requirements set forth in 1026.34A4 1 through Roman numeral 4 apply to open-end high-cost mortgages, but do not apply to closed-end high-cost mortgages. In connection with the closed-end high-cost mortgage, a creditor must comply with the repayment ability requirements set forth in 1026.43. Temporary or bridge loans with terms of 12 months or less, such as a loan to purchase a new dwelling where the consumer plans to sell a current dwelling within 12 months, are exempt from this repayment ability requirement. Roman numeral 1 under repayment ability for high-cost mortgage loans is your mortgage-related obligations. For purposes of this paragraph A4, mortgage-related obligations are property taxes, premiums, and similar charges identified in the definition section of Reg Z that are required by the creditor, fees and special assessments imposed by a condominium, cooperative, or homeowners association, ground rent, and leasehold payments. Number 2, when calculating the ability to repay, is the basis for determination of repayment ability. Under this paragraph A4, a creditor must determine the consumer's repayment ability in connection with the open-end high-cost mortgage as follows. A and B. A. A creditor must verify amounts of income or asset it relies on to determine repayment ability, including expected income and assets, by the consumer's IRS Form W-2, tax returns, payroll receipts, financial institution records, or other third-party documents that provide reasonable, reliable evidence of the consumer's income or assets. And B, a creditor must verify the consumer's current obligations, including the mortgage-related obligations that are required by another credit obligation undertaken prior to or at account opening and are secured by the same dwelling that secures the high-cost mortgage transaction. Roman numeral 3, presumption of compliance, and that's ability to repay calcs under or for high-cost mortgages. The presumption of compliance for an open-end high-cost mortgage, a creditor is presumed to have complied with this paragraph A4 with respect to a transaction if the creditor A and B. A determines the consumer's repayment ability as provided in paragraph A4, Roman numeral 2. And B determines the consumer's repayment ability taking into account current obligations and mortgage-related obligations as defined in paragraph A4.1 of this section and using the largest required minimum periodic payment based on the following assumptions. Number 1, the consumer, under assumptions, the consumer borrows a full credit line at account opening with no additional extensions of credit. Number 2, the consumer makes only required minimum periodic payments during the draw period and any repayment period. And number 3, if the APR may increase during the plan, the maximum annual percentage rate that is included in the contract as required by 1026.30 applies to the plan at account opening and will apply during the draw period and any repayment period. C, assesses the consumer's repayment ability taking into account at least one of the following: the ratio of total current obligations, including any mortgage-related obligations that are required by another credit obligation undertaken prior to or at account opening and are secured by the same dwelling that secures the high-cost mortgage transaction, to income, or the income the consumer will have after paying current obligations. Roman numeral 4, exclusions from presumption of compliance. Notwithstanding the previous paragraph, no presumption of compliance is available for any open-end, high-cost mortgage transaction in which the regular periodic payments, when aggregated, do not fully amortize the outstanding principal balance except as otherwise provided by 1026.32 D1 Roman numeral 2. So that's exclusions from the presumption of compliance. Number 5, pre-loan counseling. This is number 5. We're still within A, prohibited acts or practices for high-cost mortgages. So we've reached the 5th caveat here, I think. Pre-loan counseling. And Roman numeral 1 explains the certification of counseling that's required. A creditor shall not extend a high-cost mortgage to a consumer unless the creditor receives a written certification that the consumer has obtained counseling on the advisability of the mortgage from the counselor that is approved to provide such counseling by the Secretary of the U.S. Department of Housing and Urban Development, or, if permitted by the Secretary, by a state housing finance authority. Roman numeral 2 under pre-loan counseling is the timing of counseling. The counseling required under paragraph A5 must occur after A and B. A, the consumer receives either the disclosure required under Section 5C of RESPA or the disclosure required under 1026.40, or B, the consumer receives the disclosures required by 1026.32C for transactions in which neither of the disclosures listed under paragraphs A5 Roman numeral 2A of this section are provided. Third, affiliation prohibited, and this is under pre-loan counseling. Affiliation prohibited reads, the counseling required under paragraph A5 shall not be provided by a counselor who is employed by the or affiliated with the creditor. Roman numeral 4, the content of the certification must include the name of the consumers who obtain counseling, the date of the counseling, and the name and the address of the counselor. Further, a statement that the consumer received counseling on the advisability of a high-cost mortgage based on the terms provided in either the disclosure required by Section 5C of RESPA or disclosures required by 1026.40. Furthermore, the certification should include for transactions for which neither of the disclosures listed in paragraph A5 Roman numeral 2A of the section are provided, and a statement that consumers receive counseling on the advisability of the high-cost mortgage based on the terms provided in the disclosures required under 1026.32C. And the cert should include a statement that the counselor has verified that the consumers receive the disclosures required by either 1026.32C of RESPA with respect to the transaction, or the RESPA with respect to the transaction. Roman numeral 5 discusses counseling fees. A creditor may pay the fees of a counselor or counseling organization for providing counseling required under this paragraph A5, but may not condition the payment of such fees on the consummation or account opening of a mortgage transaction. If the consumer withdraws the application that would result in the extension of a higher cost mortgage, a creditor may not condition the payment of such fees on the receipt of certification from the counselor required by paragraph A5, Roman numeral 1 of this section. A creditor may, however, confirm that the counselor has provided counseling to the consumer pursuant to paragraph A5 prior to paying the fee of the counselor or counseling organization. Roman numeral 6, steering is prohibited. A creditor that extends a high-cost mortgage shall not steer or otherwise direct consumers to choose a particular counselor or counseling organization for the counseling required in paragraph A5. Number 6, under prohibited acts or practices with high-cost mortgages is recommended default. A creditor or mortgage broker, as defined in Section 1026-36A2, may not recommend or encourage default on an existing loan or other debt prior to and in connection with the consummation or account opening of a high-cost mortgage that refinances all or any portion of such existing loan or debt. 7, part under prohibited acts or practices with high-cost mortgages is the modification and deferral fees. A creditor, successor in interest, assignee, or any agent of such parties may not charge a consumer any fee to modify, renew, extend, or amend a high-cost mortgage or to defer any payment due under the terms of such mortgage. Late fees that are prohibited under a high-cost mortgage in general. A late payment charge imposed in connection with a high-cost mortgage must be specifically permitted by the terms of the loan contract for open-end credit agreement. Much better not. Credit agreement. Where was I? And may not exceed 4% of the amount of the payment past due. No such charge may be imposed more than once for a single late payment. Number 2, Roman numeral 2, timing. A late payment charge may be imposed in connection with a high-cost mortgage only if the payment is not received by the end of the 15-day period beginning on the date the payment is due, or in the case of a high-cost mortgage on which interest on each installment is paid in advance, the end of the 30-day period beginning on the date the payment is due. Roman numeral 3, multiple late charges assessed on payment subsequently paid. Roman numeral 4, failure to make required payment. These are the last parts. Under late payments, prohibited on mortgages, high-cost mortgages. You have multiple late charges assessed on payment subsequently paid. A late payment charge may not be imposed in connection with a high-cost mortgage payment if any delinquency is attributable only to a late payment charge imposed on an earlier payment, and the payment otherwise is a full payment for the applicable period and is paid by the due date or within any applicable grace period. Roman numeral 4, failure to make required payment. The terms of a high-cost mortgage agreement may provide that any payment first shall be applied to any past due balance. If the consumer fails to make a timely payment by the due date and subsequently resumes making payments but has not paid all past due payments, the creditor may impose a separate late payment charge for any payments outstanding without deduction due to late fees or related fees with the default until the default is cured. Number 9, under prohibited acts or practices for high-cost mortgage loans, you have the payoff statement fee prohibition. Fee prohibition is Roman numeral 1. Roman numeral 2 is processing fee. Roman numeral 3 is processing fee disclosure. Roman numeral 4 is fees permitted after multiple requests. 5, timing and delivery of payoff statements. So with relationship to payoff statements on high-cost mortgage loans, fees are prohibited. In general, a creditor or servicer, as defined in 10 CFR 1024.2b, which is RESPA, may not charge a fee for providing to a consumer or a person authorized by the consumer to obtain such information a statement of the amount due to pay off the outstanding balance of a high-cost mortgage loan. Processing fees. A creditor or servicer may charge a processing fee to cover the cost of providing a payoff statement as described in paragraph A9, 1 of this section by fax or courier, provided that such fee may not exceed an amount that is comparable to fees imposed for similar services provided in connection with consumer credit transactions that are secured by a consumer's principal dwelling and are not high-cost mortgages. A creditor or servicer shall make a payoff statement available to a consumer or a person authorized by the consumer to obtain such information by a method other than by fax or courier without charge pursuant to paragraph A9, 1 of this section. Roman numeral 3, processing fee disclosure. Prior to charging a processing fee for provision of a payoff statement by fax or courier, as permitted pursuant to paragraph A9, 2 of this section, a creditor or servicer shall disclose to a consumer or a person authorized by the consumer to obtain the consumer's payoff statement that payoff statements as described in paragraph A9, 1 of this section are available by a method other than fax or courier without charge. Roman numeral 4, fees permitted after multiple requests. A creditor or servicer that has provided a payoff statement as described in paragraph A9I of the section to a consumer or a person authorized by the consumer to obtain such information without charge other than the processing fee permitted under paragraph A9 Roman numeral 2 of the section 4 times during a calendar year may therefore charge a reasonable fee for providing such statements during the remainder of the calendar year. Fees for payoff statements provided to a consumer or a person authorized by the consumer to obtain such information in a subsequent calendar year are subject to the requirements of this section. Roman numeral 5, timing of delivery of payoff statements. A payoff statement as described in paragraph A9I of this section for a high-cost mortgage shall be provided to a consumer or servicer within 5 business days after receiving a request for such statement by a consumer or a person authorized by the consumer to obtain such statement. Financing of points and fees. Number 10, under prohibited acts or practices related to a high-cost mortgage loan. A creditor that extends credit under a high-cost mortgage may not finance charges that are required to be included in the calculation of points and fees, as that term is defined in 1026-32B1 and 2. Credit insurance premiums or debt cancellation or suspension fees that are required to be included in points and fees under 1026.32B 1 Roman numeral 4 or 2 Roman numeral 4 should not be considered financed by the creditor when they are calculated and paid in full on a monthly basis. B, under requirements for high-cost mortgages, prohibited acts or practices for dwelling secured loans, structuring structuring loans to evade high-cost mortgage requirements. A creditor shall not structure any transaction that is otherwise high-cost mortgage in a form for the purpose and with the intent to evade the requirements of a high-cost mortgage, subject to the subpart, including by dividing any loan transaction into separate parts. 1026.35 is another section titled Requirements for Higher Price Mortgage Loans. However, A includes definitions, B discusses escrow accounts, C discusses appraisals, Not to be said about appraisals. And D is evasion. So we'll get into that section next.